Well, we hope your week is going well. Welcome to the program Dollars and Cents. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. Joining me on this morning's program is fellow certified financial fiduciary and CPA as well, Kristen Cayley. Good morning. How are you?
I'm doing great, Joel. How are you?
I am fantastic. It is, as we've been talking past couple of weeks, August. Back to school month. Matter of fact, this week I noticed on, I think it was as early as Thursday, that the crossing guards were out, and I guess kind of doing the crossing guard check or practice, if you will. So traffic's going to get a little bit more out there in the next weeks ahead. That's for sure.
I noticed that too. Definitely needed to take a different route to work during the week.
Correct. Try and avoid those school districts or school areas where you got to come slowing down to a crawl. So the boys, at least one of them goes back this coming week. The other one goes back in a couple of weeks. So we don't necessarily have any fond back to school memories because they're all sort of disappearing at different times based upon when school starts. But I do remember thinking back to when the boys were younger, the fabulous first day picture on the front steps. And I'll tell you, super charming when they were like in elementary school, got maybe a little less charming in middle school, and then got some mornings on the first day of school sort of outright snarky. But we still made them sit on the front steps for that first day of picture. Kristen, how about you? You had three siblings growing up in the Cayley household. So what were you guys doing on the first day of school?
Very similar. The same sort of front step photos. We tried to do matching colors for a while. My mom kind of implemented that. Lasted up until probably middle school for me.
Wow. All matching. So all four kids had matching colors on. Wow. Yeah, that probably doesn't last past middle school, does it?
No, and I was the oldest, so middle school, that was over.
Oh, that's funny. Well, certainly we hope that your back to school is going smoothly. It certainly does cause your house to run on a little different schedule, a little different calendar. Speaking of back to school, I think the IRS needs to go back to school. It certainly seems like over the course of the past few months, we've seen an IRS that is creating new stuff without finalizing some of the old stuff. Like, I mean, that would seem to me that you'd want to go back to school to make sure that you get done what you're supposed to get done. Sort of like complete third grade before you start fourth grade would be kind of the analogy. And obviously what we're talking about is some of the things that have just come out with the IRS still struggling with how to address a law that passed in 2019. Now that's almost 4 years ago. What are we talking about here, Kristen, that they're still struggling with?
So we're talking about the stretch IRA that changed back in 2019. So back then, if you inherited an account, you had the ability to stretch it over your lifetime, just like it sounds. But now you have a 10-year liquidation period to essentially liquidate that account and take all the funds out.
So a pretty significant difference. Obviously, the game plan there is that they want to accelerate the tax implications of that money, right? Because if it's money sitting in a retirement account, then that money is sitting there on typically a pre-tax basis, so no taxes have been paid. So instead of allowing somebody to take the rest of their lifetime to take that money out over time, then lo and behold, okay, now as a beneficiary, I must take that out over a 10-year period of time. So pretty dramatic, and certainly it's something that we've been advising listeners and clients of the program to make sure that they are aware of. But there's parts of this that have not been resolved, and I think that's where the tricky part comes in. So what's the part that hasn't been resolved and continues to be unresolved on this?
Right, so that is the required minimum distribution requirement. So depending on if the inherited account came from a deceased person that was currently taking those required minimum distributions, then you as the inherited person may be required to take a required minimum distribution.
But they keep not addressing this, right? They keep not coming to a conclusion as to whether you should be taking that sort of required minimum distribution out of these accounts. And this is now, and they just came out, I guess, what was it, a couple of weeks ago, where they basically threw up their hands for this year, 2023, and said, we're not going to issue final guidance on this even now in the year 2023, 4 years after the fact.
Yeah, but it's kind of mirroring what they did last year. So last year around February, give or take, they came out saying that you'd have to take these required minimum distributions. And then months went by without giving clarification on how to take it, how much to take it, how to calculate that. And then it was in October when they came out and said, never mind, we'll let you know in 2023. Don't worry, there's no penalty. Same sort of thing happened this year.
Wow, that's just incredible. And there's been a lot of talk on this one. And here's the tricky part. If you don't take your required minimum distribution, well, there's a pretty significant penalty. That used to be 50%, but now it's 25%. But that's still not anything that I would say a taxpayer wants to really mess around with.
Right. It's a pretty steep penalty.
Plus, you would then owe taxes on that amount as well. So it can really sort of ripple up pretty dramatically. So we're going to talk a lot more about that in the program and kind of really help our listeners understand what we're talking about in terms of what the implications of this are. And then we got to hit sort of the new stuff that's rolling out. And this one has to do with a new flavor for qualified charitable distribution. So what's this one all about?
So qualified charitable distributions have been around for a long time. So this is an annual amount. It's up to $100,000 that you can contribute from your IRA to a qualified charity. Now, this is only available if you're 70 and a half and older. That was the old required minimum distribution age. And this amount, whatever you contribute towards that charity, up to $100,000, can be counted towards your required minimum distribution for the year.
Certainly a pretty powerful tax option that you have if you get to those ages where you've got those required minimum distributions kicking in for your retirement accounts. And the neat thing about qualified charitable distributions is it really does allow you to really look at your personal values and what charitable organizations you favor, and ultimately but feel good about what you're doing in making a donation to a charity, while at the same time, if you're doing the qualified charitable distribution the way you should, which is making the check payable directly to the charity, then you also get the tax savings as well, because the amount that you gave to charity serves to automatically reduce down the taxable amount of that required distribution. So, but they've got a new option, if you will, that's now available starting this year. And what is that option?
So that is a charitable gift annuity. So these have also been around for a while, but never have you been able to contribute directly from an IRA to a charitable gift annuity like this. And then what you get in return is actually an income stream for the rest of your life.
So not only do you get the benefit of donating to your favorite charity, you get the tax savings, but now with this charitable gift annuity option that you can use with your required minimum distribution, you're going to get money back every month. Mm-hmm. That's pretty cool. Well, so that means we got a lot to talk about on the program. Stay tuned through the break, and we'll continue the conversation here on Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. So, Kristen, I got a question for you. You know, you're a CPA. Do you like certainty? Is that a big part of being a CPA is all about?
I think most people like when things make sense and numbers add up.
Particularly if you're a certified public accountant, right? I mean, you would want, that's the whole point of the job, right? Yeah, is to make sure that the numbers all kind of line up. So that's good. And I guess most people would also like certainty, particularly when it comes to your taxes. Imagine, if you will, a world where the tax landscape and the rules change on a regular basis.
Unfortunately, that is the world that we live in.
I think that is the world that we live in. And we're talking about one in particular where it's taken 4 years and counting for the IRS to figure out the exact guidance to give for individuals who inherit a retirement account. And the rules have certainly changed dramatically on this. We talked about those changes in the last segment, where you go from sort of being able to take out that money from that inherited retirement account over the course of your life expectancy to now only having 10 years left to do it. And I guess the issue really comes down to, what do you have to do along the way during those during that 10-year period? And that's where the IRS has been relatively confused, I guess would be a kind word, in terms of what the approach should be.
Right. So they've come out saying that these required minimum distributions should have been taken along the way. And this applies to individuals that inherited an account from a deceased person that was already taking the required minimum distribution. So the confusion is over, do you take it over the inherited person's lifetime? Do you take it over the deceased person's lifetime? What factor do you use, and how much are you supposed to be taking out?
And the reason why calculating that required minimum distribution is so important, and you know, for our listeners, we just got to really highlight this piece of information, because if you do not take a required minimum distribution, so that applies if you're over certain ages. Today it's 73. If you've inherited a retirement account, the required minimum distribution is the amount that you must take out. Otherwise, you face a pretty significant tax penalty on that, the amount that you should have taken out, but you didn't.
Right. So this year it's 25%. That is down from, it was 50% last year.
So it's a pretty dramatic change, or dramatic cost, if you do not wind up dealing with this correctly. And there's a tremendous amount of dollars involved, right? When we talk about wealth transfer and from one generation to the next, we're literally on the threshold of what will be the largest wealth transfer in all of humankind.
Mm-hmm. Yep. So last time I looked at the numbers, it's something around $68 trillion that's going to pass to beneficiaries.
And I know when we were talking about the program and getting our thoughts together, I challenged you on that number, because I was like, that sounds way, $68 trillion. That sounds, and then you double checked, and $68 trillion.
Mm-hmm. Most of which is in retirement accounts.
Yeah, so that's a big source of tax revenue, and it's certainly a lot of money in play. And I mean, it just underscores how confusing these things can be. And we get it. It's just so frustrating as an individual, you know, trying to figure stuff out. And that's one of the reasons why we do the program, and why we've been doing the program every week now for, 30, I think the history of the program, my father-in-law, Jack Nelson, started it back in the late 80s. So I think we're coming in on about 1,700 episodes of the program. And here's the thing, there's always something to talk about. And certainly this just underscores one of those things where you've got to really kind of stay on top of it, because it evolves and it changes. And that, after all, is sort of what we do here on Dollars and Cents, not just helping you make sense out of all of those decisions involving your dollars, but to also keep you abreast of the latest and greatest changes. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Joining me is Kristen Cayley, who also is a certified financial fiduciary and a certified financial planner. Forgot that one earlier in our conversation, and a CPA. So if you're looking for someone with more credentials than probably anybody else I know, Kristen Cayley would be your person for that. Being able to integrate those taxes with your finances and create the right plan. This is just a perfect example of where you've really got to plan and think this one through, don't you?
You really do. The penalties are steep, and you have a ticking time clock, so you really need to kind of keep on it and make sure you understand these rules.
So when we think about how frustrating this is, I mean, in terms of waiting on these rules to come out, It's almost like, I don't know if you've ever called an Uber. You probably have. But, you click on it, and then like the little car thing, you think it's coming your way, and then it just keeps spinning, and it just goes in a different direction. And I mean, this is kind of like what that is, because if you've got a 10-year rule now on having money come out of a retirement account, right? Well, there's already like 3 years gone. So 30% of the time frame is gone.
Mm-hmm. Yeah, so like I said before, it's a ticking time clock. So fortunately, you got to either understand the rules or find some help or figure out what to do for the next couple of years.
So let's talk about sort of our strategy or our recommendations that we would make for folks kind of in this, because the IRS will eventually get this resolved. It doesn't change the fact that there is a 10-year clock. So can you share with our listening audience some of the general things to be thinking about if they've inherited a retirement account, or if they think they might going forward?
Yep, so a couple things that you can do now. So while we wait for the IRS to come out with their actual rules and what you're supposed to do with these required minimum distributions, what you can do for the rest of 2023, it's going to depend on your personal tax circumstances, but just a general overview is that if you think that your tax rate is going to increase and you do have an inherited account, it might not be a bad idea to just accelerate some withdrawals now, not necessarily wait for the IRS to come out and tell you how much to take out, but maybe push some income into this year since you think your tax rate's going to go up. But always, if you're pushing income into a current tax year, just always keep in mind that you are increasing your income for that year. So if you're doing any sort of FAFSA or college planning or looking at your Medicare premiums, that's always just a factor in there. If you expect your tax rate to stay the same, it might not be a bad idea to spread out the distributions over 10 years. Waiting till the last year to take out the full amount could really push you into a much higher tax bracket, which isn't always the most beneficial. And lastly, if you think your tax rate is going to decrease, then I'd say hold off for the rest of the year. Wait for the IRS to give you some guidance. No point in taking out money now, paying the higher taxes when you know that your tax rate is going to decrease in future years.
Yeah, a great example of that, and this was someone that we were working with in the office where, they had inherited a retirement account, and they were 3 years away from retiring. So the next 3 years, we knew their income was going to be relatively high because they were still working. But then that gave us the flexibility to say, okay, well then in years 4 through 10, that distribution from the retirement account then becomes your primary source of quote unquote your retirement income. And then we can turn to the other parts of your own personal portfolio to draw income from after that 10-year period. So there's definitely some really unique planning opportunities. And then the other day we saw, and this just sort of highlights the complexity, a situation where a spouse, a widow, had sort of incorrectly claimed something as an inherited account versus just using it as their own. Tell us a little bit more about that story.
Mm-hmm. So this was a very unfortunate circumstance that she was in. So if you open an inherited account like that, you have a 10-year liquidation requirement. And this was a Roth IRA too, so it's something that she wouldn't have ever had required minimum distributions on if it was opened in her own name. But fortunately, we were able to do a pretty long conference call, a little bit of a struggle there, but we were able to get the account moved over into her name, so assumed as her own, so that she can use that Roth for the rest of her life.
Well, and I am impressed that you were able to do that, because that took a lot of time and a lot of effort, but for that individual, it really made a difference to be able to not have to just simply liquidate out the account in a 10-year period of time, but rather to be able to use that for the rest of their lifetime without any required distributions. We're going to take a break and continue here on Dollars and Cents. Thanks for listening on in. Stay with us through the break. This is Joel Garris and Kristen Cayley of Nelson Financial Planning on Dollars and Cents. So it is back to school this week. We've been talking a little bit about that, seeing the last week, the crossing guards out, trying to, kind of get people used to seeing them on some of these street corners throughout Central Florida. Meanwhile, at the office, we are doing our back to school drive, and that runs through September 1st, right?
Mm-hmm. Yes.
So that's a great opportunity to donate new school supplies. Just come by our office located in beautiful Winter Park, Florida, 423 Country Club Drive. If you can't find us on Google, although pretty sure we're on Google. The reality is you can drop by those new school supplies anytime during business hours from 9 to 5. Benefits a gift for teaching through Orange County Public Schools, and also tools for Seminole Schools as well is the other organization that it benefits. So that's a good way to kind of segue into our next conversation, which is about charity, right? Always great to donate to charitable causes like a gift for teaching or tools for Seminole Schools. We've had a lot of folks stopping by the office dropping off school supplies, and it does certainly make you feel pretty good. I know a lot of the team was out of the office earlier this summer for a day of service involving the local schools. Tell us a little bit about that, Kristen.
Mm-hmm. Yeah, so back in June, a bunch of us went to the Great Big Backpack Build. So this was at the Orange County Convention Center in a huge ballroom. There were about 400 other volunteers there, and what they did is they broke you up into teams. And the point of it was to race to build as many backpacks as you can.
Competition, charitable competition. There you go.
Definitely some exercise too. So.
Oh, okay.
And they have music and a DJ, and it was a lot of fun. And overall, we, as a combined total, built about 2,000 or 20,000 actually. I'm sorry, 20,000 backpacks.
Wow.
I think our group built about maybe 1,000.
Wow, that's awesome. That's awesome. That's really cool. So it is always great to donate to charity, and I'm sure you've got your own sort of favorite charity. I have a particular affinity for Grace Medical Home. That's where my wife works. Kristen, you probably have a favorite charity as well.
Mm-hmm. Yeah, so Pet Rescue by Judy. That's where I adopted my little dog Walter from.
There you go. Well, the great thing about making a charitable contribution is you certainly feel good, but when you overlay it with a qualified charitable distribution, if you have a required minimum distribution, then not only do you get to give the gift to charity, but you also get to offset the tax implications of that required distribution. So QCDs have been around for a few years, and it's certainly something we've talked at length on the program before. But now, lo and behold, there's a new option for you to put that qualified charitable distribution to good use for. And Kristen, what is that new option?
Mm-hmm. So that is the charitable gift annuity. So this is a way that you can contribute up to $50,000 directly from your IRA to your favorite charity. So you'll get the tax deduction, so that transfer will be tax-free, and then you're donating to your favorite charity. And then in return, you'll also get an income stream for the rest of your life.
Yeah, so look, gift annuities and charitable gift annuities have been around for a long time. There's approximately 1,600 different charities that sort of offer that as an option. Typically, these charitable gift annuities are run through the charity. It's not like some insurance product or annuity product type thing that you would necessarily purchase. Usually all of that is part of the structure of that charity. There's about 1,600 charities out there that offer this option. But the real change, right, is that now you can use it with retirement dollars.
Mm-hmm. Yeah, so this is available if you're 70 and a half and up. And this can count towards your required minimum distribution for the year.
Yeah, and let's just pause there, because I know we've been kind of talking a little bit about the IRS needing to kind of go back to school, particularly on its delay for not getting out the rules yet for the legislation that passed in 2019 involving the stretch IRA. I think here's one where they also are a little kind of weird. Like, they talk in the rules about 70 and a half still being the required minimum distribution age and allows you to do the qualified charitable distribution. Mm-hmm. But to be clear to our listeners, the age is 73.
Yes, that's right.
So am I confused? The IRS confused, or they just need to go back to school?
I think they really do.
Probably do. So, but just know that at 70 and a half, even though you don't technically have a required minimum distribution requirement, you could, if you were so charitable minded, take advantage of that as early as 70 and a half. You don't have to wait to 73 if you're delaying on your qualified distribution. So just I want to just take a pause on there and just kind of talk that one through, because it sounds like we're throwing out a couple of different ages, and we are. We're not confused. It's the IRS that's kind of confused on this thing. But anyway, just thought I would clarify that. So give us an example of how one of these charitable gift annuities would work now that you can use that and fund those with retirement dollars.
So the lifetime limit is $50,000. That's the most that you can transfer into one of these annuities, the charitable gift annuities. You can make it as a one-time $50,000 donation, or you can do $5,000 for the next 10 years. So however you'd like to fund it. And then what you can do is you would actually get an income stream back depending on how old you are. So the younger you are, the less you're going to get back on an annual basis. The older you are, the more you'll get back. So if you're, let's say, 70 and a half, you'll get about $250 a month, give or take.
Okay, all right.
And then if you're closer to 90, you'll be getting around $500 or so a month.
So $250 a month, that's about $3,000 a year. Cool thing on that, I mean, that may not sound like a whole lot of money, but if we think of it as, $3,000, that's a pretty decent weekend getaway that you'd be able to enjoy with that. And that's the annuity part of how these work, whereby there is that stream of income back. The older you are, the more money or the greater the percentage that comes back. So certainly a pretty interesting option that's now available as an option to do with that qualified charitable distribution. I mean, that really is... And the analogy that I would say is, I mean, that's really like having your cake and eating it too, right? I mean, I like cake. Do you like cake?
I do like cake. I like funfetti.
Funfetti. Okay. I like any kind of cake, so I'm not very discerning. This summer, of course, with the boys home, there's been a lot more cakes and baked goods around the house. So we've been enjoying those. Come the fall, when everybody goes back to school, we'll get back on the more stringent diet. But when the cupcake's laying there, you got to eat it. But this really does allow you to save money on your taxes, get the offset of the charitable deduction, and still get income back. So just an amazing opportunity if you think of it in terms of the opportunity to make a charitable gift annuity that has always certainly been an option, but certainly not one that you were able to do with your retirement dollars. And that's new for this year.
Yeah, starting 2023.
So good option for folks to be considering. And certainly, this is a good example of the kinds of things that we continue to keep track of on a regular basis, which is why we encourage folks to listen regularly, not just listen regularly to the live program that goes out on Sunday mornings on a variety of stations throughout the Central Florida area, but also to make sure that they are subscribing to our podcasts platform. So whether that's Amazon, or whether that's our YouTube channel, or whether that's your Spotify or iTunes, make sure you subscribe to us, because it's through these weekly episodes that we do that we're able to keep people informed of the latest and greatest. Speaking of the latest and greatest, there's an update that we want to share with our listeners as well. Finally, a tax form was finalized for the year 22. Another incredible example of how far behind the IRS is on its homework. If they were this late on doing their homework, they would have flunked elementary school, but they're the IRS, and when you've got a form and it takes them that long to finalize it, then you just kind of have to wait. I think you said we had like 6 different tax returns that we were holding to finalize because this particular tax form had not been finalized. So I want to share that with our listeners because it's a great way to save money on your taxes to the extent that this particular option is available to you. So we're going to go to that when we return here on Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. Well, welcome back to the program. Thanks again for joining us this week. We've covered a host of topics on the program, and certainly appreciate your listening on into us or subscribing to us on your favorite podcast platform of choice, or maybe you get to see us in real well, not real life because it's still on the internet, but you get to see like a video of us, which is sort of quasi real life. And on our YouTube channel, check out our Nelson Financial Planning YouTube channel. If you have any problems finding us on any of those platforms, just go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Make sure you click on the one that looks most familiar to you, and then you will get immediately connected to our channel on that particular platform. Also want to give an opportunity for folks to use the website. We've talked about a lot on the program this morning, Kristen, about the new rules involving what happens when you inherit an IRA, and then the new option that you have under as a qualified charitable distribution. But we want to make sure that people know that on the website, they can ask us a question, or if they've heard something on the program this week that raises a question in their minds as to, okay, what should I actually be doing? Website's a great way to do that, right?
Mm-hmm. We get notified instantly, so it's a great way to reach out to us.
Fill it all in with your questions, so make sure you stay in touch with us that way as well. Now, before the break, we were talking about a tax form that just got finalized that does have some ripple effects, particularly for folks here in Florida. So what are we talking about? What's this form, and what's it have to do with my taxes after all?
Mm-hmm. Yep. So for the 2022 tax year, so that was your taxes due back on April 15th of this year, there's a new form. It's the 8915F, and essentially what it does is it allows for qualified disaster distributions from your retirement accounts. So if you are under 59 and a half and you take money out of a retirement account, if it doesn't fall into one of the handful of exceptions, there is a 10% early withdrawal penalty.
Pretty significant. So not only do you have to pay taxes on it, but you got to pay the 10% penalty unless you can get one of these exceptions to count towards you.
Mm-hmm. So this is separate from that, and it allows you, it's a lifetime amount of $22,000 to come out of one of these qualified plans. So it could be a 401k, could be an IRA, could be a Roth. So you can take out up to $22,000 for a qualified disaster and use it towards whatever you need it to.
And to clarify that, so that would be like a hurricane or flood or fire or whatever the case may be. And certainly there are a variety of zip codes in Florida that absolutely qualified for that. Now, do you have to, is there any particular restriction on sort of what you needed to use the money for, or is it just if you were in that qualified disaster zone, then you're eligible for this exemption?
So if you're in that area and then you take out the funds within, it's about 6 months from the disaster date,
Mm-hmm.
and you use it towards anything related to the disaster. So actually for all of Florida, Hurricane Ian impacted every region.
Okay.
So if you were impacted in any sort of way by Hurricane Ian and you had to do, let's say your roof needed to be repaired or there was flooding, and you took an amount out from your IRA and it was an early withdrawal, so before you turned 59 and a half, most likely you were hit with a 10% penalty on your tax return. But using this form, you would be able to avoid that 10% penalty.
And the crazy part of this is that this form was finalized by the IRS in May. Our software company, and I'd like to think we use one of the premier software companies that a lot of accounting firms use, it just got through finalizing the form on their end.
Yeah, so at the end of July, about 2 weeks ago, give or take.
So it's end of July. So now we're going back through. We're relooking. I think you said to me earlier this week, hey, I got about 6 returns that are going to come my way to kind of take a final blessing on, and to look at them, because now they were ones that fortunately we knew this was coming. Right, and so we did not file a final return for these people, but we said, okay, we're just going to project how much we think you're going to owe. You make sure, or refund, and you make sure you take care of that, and then we'll finalize the tax return later on. And in some cases, I mean, this was a $2,000 swing.
Mm-hmm. Yeah, saves you that full 10% on up to $22,000.
Pretty significant. So again, we're going to use this as an opportunity. You know, look, if you took money out of your retirement account last year and you did that as an early withdrawal, right? And you paid the penalty, which is 10% of the amount you took out, you may want to take another look at that, right? Because if you filed by April 15, which vast majority of people do because that's the deadline, then you would have wound up paying the penalty on this without realizing, because the form wasn't finalized until May, that you might have been able to exempt yourself from this penalty altogether.
Right. And a lot of people, their retirement accounts are their biggest asset. So if an emergency does come up, this is probably the perfect place to take the funds from.
Sadly, we wish that was not the case. We wish everybody had their proper emergency savings account put together, and it's 6 to 9 months. And I know we've talked for years and years and decades on the program about that, and pretty much every financial publication you read would say start with an emergency savings account, but we also understand we live in the real world, and we also understand that sometimes people don't do that, and so they tap into those accounts, but to the extent you're having to tap into the account, you don't have to pay an extra 10% when you didn't need to.
Exactly, right.
And that's certainly the case with this particular item. So if you if you took money out of a retirement account last year, or you know somebody who did and is not over the age of 59 and a half, so it's technically an early withdrawal, certainly something to re-look at. And I guess what would you do? I guess you'd have to file an amendment on that, right?
Yeah, it's an amendment, unfortunately.
Yeah. So that's a little bit of a process. What are refunds running on amendments these days? Is it like 2 months, 3 months? It's a long period of time.
Last time I checked, it's up to 16 weeks, so looking at even 4 months.
Wow. Okay, so that's a long time, but certainly a way to save money. So certainly an interesting range of conversations that we've had on the program. First of all, the Stretch IRA. Nothing final on that. If you're waiting for final rules on that, you're going to have to wait another year to get to final on that. But that doesn't mean that people shouldn't really be thinking about and planning for it anyway.
Right. Depending on what your tax rate is, you might want to take out some of those withdrawals now. You might want to wait till next year. You might want to wait till year 10. Every situation's different, so just kind of whatever would work best for you.
Well, and I think this is, Kristen, is where your area of expertise would really come in directly to benefit people in terms of analyzing the situation, because you're a certified financial planner, you're a certified financial fiduciary, and you're also a CPA. So that's one of the biggest reasons at Nelson Financial Planning why we have a tax department internally as part of the team, because so much of this is so related and so correlated, isn't it?
Every financial transaction has some sort of tax consequence one way or the other.
Wish that wasn't true, but it is. And then if you're one of the folks that likes charities and is charitable minded, you've got a new option under for qualified charitable distribution involving a charitable gift annuity, right? That one is new because you get to do retirement dollars in there now, where before you weren't able to do that.
Yes. Right.
So certainly some interesting stuff. Again, we'll open up the website. Not that it's not closed, because it's always open, because it's the website. Give us your call. Give us your questions on the website. If you think that some of the stuff that we've talked about today might be applicable to you, certainly a great way to reach out to us through our website at Nelson Financial Planning. My name is Joel Garris. This is Kristen Cayley. You've been listening to Dollars and Cents. Enjoy the rest of your weekend.